I want to introduce the concept of mutual funds to you, understanding mutual funds. I want to talk about the key characteristics, the risk, and as well as the benefits of mutual funds. And mutual funds actually are investment vehicles that pool money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other securities. They are managed by professional fund managers who make investment decisions on behalf of the investors. Let me highlight the key features here. Number one is diversification. Mutual funds typically invest in a broad range of securities, which help reduce risk by spreading investments across different asset classes or sectors or industries, as the case may be. Number two is professional management. Professional management. Mutual fund actually are handled by professional managers when it comes to investment decisions, when it comes to research and portfolio management, which is beneficial for investors who prefer a hands-off approach. Investors who don't want to get involved in the day-to-day management of their portfolio can take advantage of mutual funds investments. Number three is liquidity. Mutual fund shares can generally be bought or sold in any business day at the fund's net asset value, making them relatively liquid investment. The net asset value here comprises the values of all the shares that are, that makes up or make up the fund in question. Its constituent companies. Number four is variety of types. There are many types of mutual funds, including equity funds, bond funds, money market funds, and balance funds, each with different investment objectives and strategies. They have different strategies, they have different objectives, and they tend to be managed with a different set of skills. Number five is regulated. Mutual funds are regulated by government agencies such as the SEC in the US and the SEC in Nigeria as well, which provides a layer of investor protection. Investors are protected somewhat because of these the activities of the regulatory agencies foreseeing the conduct of these funds. I want to highlight the advantages of mutual fund investments. Number one is diversification. This reduces risk by spreading investment across various securities and sectors, which can help stabilize returns. Number two is professional management. It provides access to experienced fund managers and research, which can be valued for investors, which can be valuable for investors without the time or expertise to manage their own portfolio. You don't have the time, you lack the expertise to manage your own investment or to pick individual stocks, then you could buy a mutual fund. Number three is accessibility. Mutual funds are widely available and can be purchased through various channels, including brokers, banks, and online platforms. Number four is automatic reinvestment, or rather automatic reinvestment. Automatic reinvestment. Many funds offer automatic reinvestment of dividends and capital gains, which can help grow the investment over time as the capital gain comes out, as the dividends are paid. This uh, fund is reinvested automatically back into the mutual fund. Number five is variety. It offers a wide range of options to match different investment goals, risk tolerance, and time horizon. Whatever is your time horizon, whatever is your risk tolerant level, whatever is your investment objective, you have different funds that could take care of those preferences. Number is we now come to the drawbacks, the disadvantages. Number one is management fees. Mutual funds charge management fees, which can impact overall returns. These fees include an expense ratio, and in some cases, sales, there's this particular sales charges, front end and back end loads. So usually there's what they call expense ratio, and it varies from fund to fund. So they charge these as management fees. Number two is lack of control. Investors have no say in individual investment decisions, as fund managers handle all buy and sell decisions. That's why you invest in them. You're not expected to have any say. You kind of cede your freedom of decision making to the fund manager, trusting that the manager will make the right decisions when it comes to managing your investments. Not only that, you have number three, tax implication. Investors may incur capital gain taxes if the fund manager buys and sells securities within the fund, which can affect the after-tax return. As the manager sells securities, the government collect tax. They tax that particular sale as capital gain tax. And we equally have number four, potentials for underperformance. Not all mutual funds outperform their benchmark or the market, and past performance is not a guarantee of future results. Generally, people tend to sell off poor performing funds and buy, the ones that performs very well. But they forget the fact that, past performance is not a guarantee that the fund will still perform very well, perform positively, will make profits in the future. And for the fact that a fund is currently struggling doesn't mean that it will continue to struggle forever. And so there is number five, price impact. Mutual fund transactions are executed at the end of day, and which may not reflect real-time market conditions. Unlike stocks, when you buy a stock, when you buy or sell a stock, you are buying at the prevailing price at that minute. At the minute you are buying at that particular price. When it comes to mutual fund, you buy at the end of the day. There is no kind of like intraday, price or whatsoever. You buy your fund at the end of the day, kind of like at the closing price. So we want to look at types of mutual funds. There's equity mutual funds. These invest primarily in stocks. They can focus on specific sectors, region, or investment style, example, growth or value. So they buy primarily, they focus essentially on stocks and equities. Number two is bond funds. They invest in various types of bonds, with government bonds, municipal bonds, corporate bonds, and they aim to provide regular income. We equally have money market funds. They invest in a short-term, high-quality investments such as treasury bills and commercial papers, as well as offering, low risk and liquidity. That's for money market fund. Number four is balanced fund. You know, they invest in mixed or stocks, mix of a kind of a mixture of stocks, stocks and bonds to provide both growth and income, balancing risk and return in the process. You probably have number five, sector funds, focus on specific sectors of the economy, such as technology or healthcare, allowing investors to target particular, area of personal interest. Mutual funds offer a convenient way to invest in a diversified portfolio, managed by professionals, and making them a popular choice for many investors. However, it's important to understand their fees, tax implications, and how they fit into your overall investment strategy. Please give this video a thumbs up and subscribe to this channel.